Hey everyone, it's Nick from Sure Dividend here, and in today's video we're going to be talking about 4 Dividend Aristocrats to buy today. To begin with, I'm going to talk about what is a Dividend Aristocrat. The Dividend Aristocrats are the best of the best when it comes to dividend growth stocks. The requirement to be a Dividend Aristocrat is membership in the S&P 500, the requirement of certain minimum size and liquidity requirements, and 25 plus years of consecutive dividend increases. That last requirement is the most important, because it takes a strong and durable competitive advantage to hike a dividend every year for more than 2 decades. So why invest in the Dividend Aristocrats? Well, their performance speaks for itself, to be honest with you. If you look at the following table, which is provided by the index provider S&P, you can see that the Dividend Aristocrats have realized annualized total returns of 12.58% over the past 10 years, while the S&P 500 has realized annualized returns of only 9.73%. So, in other words, the Dividend Aristocrats have outperformed by nearly 3 percentage points per year over the last decade. This is what it looks like when you plot it on a line chart. Now, if you're interested in learning more about the Dividend Aristocrats, scroll down to the description of this video where you can download an Excel document containing the names, tickers, and financial characteristics of all 53 Dividend Aristocrats. So the first Dividend Aristocrat we'll be talking about today is Walgreens Boots Alliance, which trades on the NASDAQ exchange under the ticker WBA. Walgreens is one of the world's largest pharmacy and retail companies. It has over 13,200 stores in 11 countries and employs more than 400,000 people. So why buy Walgreens today? The company has a remarkable mix of really cheap valuation and strong fundamental financial performance. In January, the company reported financial results for the fourth quarter of 2018. Sorry, that should be 2017. Top line sales of $30.7 billion increased by 7.2% over the prior year period. Adjusted earnings per share increased by 15.5%. Now, the segment that drove Walgreens' strong performance was the Retail Pharmacy USA segment, which is the segment that most of us will be familiar with as consumers. In the quarter, the Retail Pharmacy USA segment saw sales increase by 8.9% and comparable store sales increased by 4.7%. These sales were boosted by digitization efforts. More than 20% of Walgreens' refilled drug prescriptions started in digital channels, with the mobile app being the notable driver of this. The company's valuation is also very compelling. Walgreens is expecting to report adjusted earnings per share in the range of $5.45 to $5.70 for the full year of fiscal 2018. Using the midpoint of this guidance, Walgreens is trading at a price-to-earnings ratio under 12 right now. Now, for some context, Walgreens has traded at an average price-to-earnings ratio around 17 over the past 10 years. This combination of above-average growth, remember the company just grew its earnings by 15.5% in the most recent quarter. So this combination of above-average growth and below-average valuation provides a compelling buying opportunity for today's investors. The next Dividend Aristocrat that we'll discuss is Exxon Mobil, which is the world's largest publicly traded energy company. Exxon trades on the New York Stock Exchange under the ticker XOM. Tracing its roots back to Rockefeller Standard Oil, Exxon currently operates in 4 segments: upstream, downstream, chemical, and corporate and financing. The real story with regards to ExxonMobil is oil prices. The company's financial results and its stock price have suffered as oil prices fell well below the normal levels starting back in 2014. So between 2014 and 2016, to just put some numbers behind this, the average price of West Texas Intermediate crude oil fell from $108 to $26. Now, unfortunately, Exxon's expenses were not so elastic. This had a profound impact on the company's financial performance, and Exxon was forced to sell assets and make other tough capital allocation decisions. Now, with that said, it's presented a buying opportunity for investors who don't yet own Exxon or who want to add more Exxon to their investment portfolio. The company's stock price fell from around $104 to a low of about $69. And a quick checkup said that the company's not far off the $69 low point right now. Now, of course, a drop in stock price means nothing if the fundamentals have deteriorated as much or more. Now, this is where investing in and analyzing ExxonMobil becomes tricky, because the company can't be analyzed using traditional metrics like the price-to-earnings ratio due to the cyclicality that's inherent in its business. So what are investors to do? We believe that ExxonMobil should be analyzed using the PE10 ratio, which is also called the cyclically adjusted price-to-earnings ratio, or the Shiller PE. And it's used to analyze cyclical companies like Exxon. You can calculate this metric by taking the company's current stock price and dividing it, instead by its earnings right now, you divide by the average earnings over the past 10 years. Now, Exxon's average earnings over the past 10 years have been $5.96. Dividing the company's current stock price by this average earnings figure gives a PE10 of about 12. Now, for context, Exxon has historically traded at a PE10 of approximately 14, so the company is reasonably undervalued right now. The next Dividend Aristocrat we'll discuss is Cardinal Health, which is one of the 3 largest United States drug distribution companies, along with McKesson and AmerisourceBergen. Cardinal Health currently serves over 24,000 United States pharmacies and supplies drugs to more than 85% of the nation's hospitals. A dirt cheap valuation is the defining characteristics of the Cardinal Health investment thesis. There are 3 reasons why the company is so cheap right now. The first is the potential entry of Amazon into the pharmaceutical distribution industry. While this is certainly a possibility, and Amazon has shown the propensity to go into industries that it's not already in, we believe that this is unlikely because Amazon usually goes into industries with high margins and undercuts competition with the goal of gaining market share. Cardinal Health's business model just means that this isn't possible. There's not high enough margins. To put some numbers behind this, the company operated with a gross margin of 5.3% and a net margin of 1.4% in the most recent quarter. To put it another way, in order for the company to earn $14, it had to sell $1,000 of drugs. That's really low margins and makes us believe that Amazon's probably not going to enter this industry. The next reason why Cardinal Health is so cheap is the potential legal implications that the company has in the opioid crisis. Now, this is a very real problem for the citizens of the United States, and someone should certainly be held responsible, but Cardinal's role in the crisis appears to be minimal, and we believe the likely legal outcomes from this should not impair the company's long-term profitability and growth. The third reason why Cardinal Health is so cheap right now is because the company's earnings have fallen amid a pricing war among the big 3 pharmaceutical distributors, which, as we mentioned earlier, are AmerisourceBergen, McKesson, and Cardinal Health. Now, with that said, we do not expect this intense period of competition to last, and the company's earnings and margins should revert to their historical means over time. Now, amid all these headwinds, the company's actual fundamental performance continues to be quite strong. In the most recent quarter, the company printed 6% year-on-year revenue growth and 13% growth in adjusted earnings per share. The company's valuation is also compelling. Cardinal Health expects to report earnings per share between $5.25 and $5.50 in 2018, which ends, for Cardinal Health, their fiscal year ends June 30th. This implies a price-to-earnings ratio of around 11 at the midpoint of the guidance band. Given the company's 10-year average price-to-earnings ratio is around 17, we believe that today's investors will be well rewarded for buying Cardinal Health stock. The next and last dividend aristocrat that we'll talk about in this video is AT&T, which is the largest domestic telecommunications company based on market capitalization. Its only competitor of similar size is Verizon Communications. AT&T's stock price is dirt cheap and reflects uncertainty surrounding the acquisition of Time Warner, which is an $85 billion acquisition that was announced in October of 2016. Now, to the amazement of many investors, the Department of Justice announced in November that it would be filing a lawsuit to stop the acquisition. This was a surprise to both AT&T and its investors. The company stated in a press release that the lawsuit is a radical and inexplicable departure from decades of antitrust precedent. Separately, the company's CEO said the best legal minds in the country agreed this deal would be approved. Make no mistake, the Time Warner acquisition offers a number of unique benefits for AT&T as the acquiring company. It will allow the telecommunications behemoth to provide new levels of choice, innovation, and value through an end-to-end media experience. The merger is expected to be accretive to adjusted earnings per share and free cash flow per share within 1 year of closing, and it's also expected to improve AT&T's already sound dividend coverage. With all this said, our investment thesis for AT&T is not solely or even primarily dependent on the Time Warner acquisition. Still, we believe there's a good chance that the acquisition will close, given the comparable precedent in the form of Comcast's 2011 acquisition of NBC Universal. Aside from the Time Warner lawsuit, what really stands out about AT&T is the company's valuation and dividend yield, especially the latter. Simply put, AT&T is likely the single safest company to have a dividend yield above 5%. This is possible because of the company's very low valuation. AT&T's recently published annual report provided guidance for earnings per share of approximately $3.50 for fiscal 2018. Based on this figure, AT&T is currently trading at a price-to-earnings ratio of around 10, which is very, very low for any publicly traded company. Thanks for watching this video. I'm going to give you 3 tasks to do next. The first is to email me a video recommendation at nick@suredividend.com. The second is to like this video and leave a comment telling us what you thought of it. And the third is to subscribe to our channel, Sure Dividend, if you're interested in learning more about investing in high-quality dividend growth stocks for the long run. Thanks for watching, and we'll see you next time.